The price is lying because the real stress isn't on the screen, it's in the spread. And yes, exactly why gold and silver are starting to behave like the last exit in a burning theater. Not because the world suddenly felt nervous, not because someone flipped a doomsday switch, because when markets lose the ability to price tomorrow, they start paying up for what can't be printed, can't be defaulted on, and can't be re-rated by a press conference. And the part almost nobody is watching is the one thing that exposes stress before it becomes a headline: how much the market is willing to pay for metal now versus later. That's where the pressure hides. And if you stay with me, I'm going to give you the exact checklist I am watching into the end of this month, the levels that matter, and the two scenarios that decide whether this is a controlled climb or the kind of squeeze that makes price gaps do the talking. Here's the uncomfortable truth. Global financial chaos is not random. It's structured. It's incentive-driven. It's what happens when policy uncertainty mutates faster than portfolios can hedge. When traders can't tell whether the next month is going to be a growth scare, a renewed inflation scare, a trade war flare-up, or a sudden liquidity event that forces everyone to grab dollars at the same time. In that environment, your model becomes a liability. Your valuation spreadsheet becomes a story, and the market shifts from pricing outcomes to pricing the inability to forecast outcomes. That's a totally different game. And when that game starts, gold doesn't need a growth narrative. Silver doesn't need an earnings call. They just need the system to lose confidence in its own predictability. Because that OS, when store of value, stops being a slogan and turns into a bid. Now let's anchor this in reality, not vibes. Recently, gold has surged from roughly the low 4,000s into the mid 4,000s per ounce. And silver has gone from the kind of prices people were used to ignoring to levels that force even skeptics to look up from their screens. Those are not gentle moves. Those are positioning got hit, liquidity thinned, someone was offsides kinds of moves. And whenever you see that, your first job is not to cheer or panic. Your first job is to ask, what mechanism is forcing participants to do something they would want to do? Because if you can answer that, you can stop getting emotionally dragged by every candle. And that's where the real edge starts. Most people watch the headline price like it's the truth. It's not. Price is a print, a snapshot. It can be pushed around by leverage, by options hedging, by margin rules, by liquidity droughts, by forced deleveraging, by sell what you can days. The truth leaks out somewhere else first. It leaks out in the structure, in the term structure, in the spreads, and what it costs to get the metal now versus later, in the parts of the market that are harder to manipulate with pure paper. So here is the hidden detail that reframes the whole story. When the market starts paying a premium for immediacy, that is not investor sentiment. But that is the system telling you that availability, location, and timing matter more than the nominal price on your app. And when that happens in metals, it's the closest thing you get to an X-ray of stress in the plumbing. Let me make this simple, because people love to make it sound mystical. Metals trade across time. You can buy a contract for near delivery, or you can buy a contract for later delivery. Under normal conditions, later delivery often costs a bit more because storage and financing exist, and because the market is basically saying, you can have it later, no problem. That's contango. That's the market being relaxed. It's the market saying, time is cheap. But when the near month starts getting expensive relative to later months, that's backwardation or backwardation-like behavior. That's the market saying, I don't want your promise, I want the thing. That's not a philosophical statement. That is a logistical statement. That is a scheduling statement. That is a who actually has metal in the right place, in the right form, at the right time statement. And when you see it, you're watching inventory anxiety gain a clock. Now, does that automatically mean we're out of metal? No. And this is where smart people get trapped by dumb arguments. It doesn't have to be a global shortage. The most dangerous shortages are geographic. The most violent squeezes are location-based. Because the benchmark price might be set where the metal isn't, while the metal might be sitting somewhere else, in a vault, in another jurisdiction, in another form, with another owner, not ready to be delivered into the specific mechanism that settles the trade. That's where paper meets physics. And physics always wins, eventually. And that's why this matters right now, not someday. Because when the market turns into a timing problem, calendar catalysts become gasoline. Month end, quarter end. Option expiry, delivery windows, thin liquidity around weekends, central bank meeting weeks where positioning gets tightened like a vice. These aren't abstract events. These are deadlines, and deadlines force behavior. Think about what a leveraged participant cares about. They don't just care about price, they care about volatility, they care about margin. They care about whether they can hold a position through a violent swing without getting tapped out. And when the market structure changes, the rules of survival change overnight. That's not theory. We've literally seen moments where exchange margin requirements get raised in a hot metal market. And what happens next is always the same movie, just with different actors. A margin hike doesn't change long-term supply and demand. It changes who is allowed to stay in the trade. It forces participants to either post more collateral or reduce exposure. Translation: it can create forced selling even in a bullish setup. It can flush weak hands. It can give the illusion that the move is over right before the market tightens again once the excess leverage is gone. And that's where people get emotionally manipulated, because the candle looks like failure, but the mechanism is actually a reset. And that's not the part that matters most. The part that matters is what those margin events reveal. Volatility is a weapon, not in a cartoonish conspiracy way, in an incentive way. Risk managers respond to volatility by tightening terms. That tightening forces position reduction. That reduction can push price against the crowd. And price moving against the crowd can force more reduction. That feedback loop is how markets create pain even when the bigger trend is intact. So when you hear someone say metals are the last safe bet, don't interpret that as metals are smooth and calm. The opposite is often true. In chaotic regimes, even the safe asset can whip around violently. Safety is not the same as low volatility. Safety is about what survives when confidence breaks, and that distinction will save you from doing something stupid at the worst possible moment. Now let's stack the evidence, because one argument is never enough in markets like this. You want layers, you want mechanisms that agree with each other from different angles. So here are the pressure points that make this setup credible, even if you're skeptical. First layer, macro uncertainty that's hard to hedge. Not inflation is up or rates are down in a simple way. More like policy is unpredictable, trade friction can reappear quickly, and the market is being forced to price a wider distribution of outcomes. When that distribution widens, capital looks for anchors. Hard assets benefit not because they're magical, but because they're outside the promise network. Second layer, the safe haven bid shows up hardest when equities wobble on policy shocks. You'll see risk assets dump, volatility jump, and then you start to see money move toward assets that don't require a narrative about next quarter RS margins. And when the bid shows up in metals during those moments, it's the market telling you, I'm hedging regime risk, not just buying a dip. Third layer, central bank behavior. Central banks don't buy gold because they saw a YouTube chart. They buy because reserves are about credibility and optionality. They're managing currency risk, sanctions risk, geopolitical risk, and confidence risk. And when reserve managers tilt toward gold, it's not a trade. It's a structural vote that trust is not free anymore. The bid is slow. It's not always visible day to day. But it can change the floor under the market because it doesn't need to sell on a bad headline. Fourth layer, institutional flow and visible flow. People obsess over ETFs because those holdings are public, they're easy to track, and they're a clean story. But the real story is often the flow you can't see. Industrial procurement decisions, wholesale demand vault movements, regional premiums, and the sudden tightening that happens when metal needs to move from one place to another and logistics become the constraint. ETF buying can amplify a move, but location stress can ignite it. Fifth layer, market structure signals, term structure, spreads, and delivery dynamics. When the market starts behaving like near-term metal has a premium, that's not a meme. That's a signal that immediacy is valued. And immediacy is valued when participants are worried about accessing metal at the settlement point, not just owning exposure in theory. That's the paper versus physical tension people talk about, but usually in a way that sounds like a thriller novel. In reality, it's simply this. Exposure is easy, delivery is hard. And when delivery gets harder, the pricing mechanism starts to strain. And here's a sixth layer because you always want one more, the behavioral layer. In chaotic regimes, narratives flip fast, the public gets whipsawed, analysts revise targets after the move. Social media turns every candle into a worldview. That emotional noise creates opportunity for forced buying and forced selling because the crowd S timing gets worse as volatility rises. That's when disciplined frameworks matter more than opinions. Now, there's a force trying to suppress this move, and it's not a secret cabal. It's the natural gravity of modern finance, the need for stability narratives. Institutions, policymakers, and even corporate media have incentives to frame volatility as temporary, contained, manageable. Because confidence is a policy tool. But markets don't care about your messaging strategy. Markets care about collateral, liquidity, and deliverability. And when those tighten, narratives get dragged behind price, not the other way around. So what does this setup force participants to do? This is the question that matters this week. If you're a short in silver and price spikes fast, you don't just think again. Your broker thinks for you. Your margin requirement rises. Your mark-to-market loss expands. Your collateral gets consumed. At a certain point, you are not deciding to cover because you changed your thesis. You're recovering because you have to survive. That's short covering mechanics. It's not moral. It's not ideological. It's arithmetic. And in a thin market, forced covering can turn into a vertical move because liquidity disappears exactly when demand becomes inelastic. If you're an options dealer and price runs through key strikes, you don't get to say, I disagree. You hedge. If the market is in a regime where gamma exposure makes your hedging procyclical, you end up buying as price rises and selling as price falls. That can create reflexivity. It can turn a breakout into a chase, and it can turn a dip into an air pocket. This is why this move isn't emotion, it's math, is sometimes literally true. Because options hedging doesn't care what you feel, and that's where the real pressure starts. Now, I'm not going to pretend I can hand you one magic number and say, if gold hits X, it's over, because that's not how real markets work. But levels matter because they are where behavior changes. They're where positioning flips, they're where leverage breaks, they're where risk managers call, they're where stop orders cluster, they're where dealers' hedging flow changes shape. Levels are not astrology, they're crowd mechanics. In silver, round numbers like 100 become psychological magnets because they concentrate attention. They attract options activity. They become reference points for headlines. They become the line where this is noise flips into this is a regime shift. And when you approach those lines in a market that's already volatile, you're not just watching price. You're watching what happens to liquidity around that line. Do offers stack, or do they vanish? Do dips get instantly bought, or do they cascade? Do spreads tighten into the move, signaling real demand, or do they widen like a warning flare? In gold, new highs aren't just bragging rights. They matter because they break the mental model that gold is a legacy asset. New highs force institutions to revisit allocations. They force skeptics to reconsider opportunity cost. They force trend followers to engage. They can also force hedgers to hedge more because the move becomes undeniable. And when a move becomes undeniable, it becomes crowded. And when it becomes crowded, volatility rises. That's the trade-off. That's the price of being right in a chaotic regime. And now comes the calendar trigger you cannot ignore. We are moving into a window where late month positioning meets a major central bank meeting week. The end of the month is a real thing in markets. Funds rebalance, risk budgets reset. Some participants need to show exposures. Some need to reduce them. Liquidity can thin because people don't want to be the one holding risk into a binary event. And the coming Federal Reserve meeting days, late January, are exactly the kind of catalyst that can compress decision making. Not because the Fed will magically make gold go up, but because positioning gets tightened, hedges get adjusted, and volatility expectations get repriced. And the next detail is what flips the whole setup. It's not just the Fed. It's just how the market behaves when everyone tries to hedge the same uncertainty at the same time. If you get a policy statement that removes uncertainty, you can get a violent pullback in metals even if the long-term thesis is intact, because hedges come off. If you get a statement that adds uncertainty, you can get continuation because hedges go on. And in a market where spreads are already tense and liquidity is thin, those reactions can gap. So you need a two-scenario lens. Because pretending there's only one outcome is how you get emotionally manipulated. Scenario 1 is the controlled pullback and retest. This is the healthy version. Price pulls back, not because the thesis broke, but because leverage got rinsed, because margins tightened, because late buyers got shaken, because profit-taking hit, and because the market needs to build a higher floor. In that scenario, what you want to see is support holding at obvious levels, not necessarily perfectly, but with aggressive dip buying. You want to see the market refuse to stay down. You want to see spreads remain relatively firm, meaning the now premium doesn't fully evaporate. You want to see that any sell-off feels like liquidation, not like a new wave of confident selling. You want to see that the market is still structurally tight, even while the headline price breathes. Scenario 2 is the continuation squeeze. This is the gap risk version. Price continues higher in bursts. Dips are shallow, pullbacks get front run. Key levels break, and then price doesn't give you time to react. In that scenario, what confirms it is speed, not hype. Speed. You'll see liquidity vanish at key lines. You'll see acceleration through strikes that look like magnets. You'll see volatility jump, and yet price still climb, which is the hallmark of forced participation. And if that happens into a calendar window where people are underhedged or overshorted, you can get the kind of move that feels irrational until you remember that margin calls are not rational. They are mandatory. Both scenarios are possible. Both can happen in sequence, and both can hurt you if you treat every candle like a referendum on your intelligence. Now, let's talk about the counterpoints, because this is where trust is built. If someone tells you metals are the last safe bet, without acknowledging what can go wrong, they're not doing analysis, they're doing content. Counterpoint 1, metal can move. If the market is tight because of location, the pressure can ease if metal is incentivized to flow to the benchmark hub. Premiums can attract supply, arbitrage can work, the system can relieve stress. It might not happen instantly, but it can happen. And when it does, the spread signals can normalize even if the headline price is still high. Counterpoint 2, Policy clarity can unwind risk hedges. If the market gets a narrative, it can price, whether it's inflation is under control, or growth is stable, or trade tensions cooled, or liquidity is fine. You can see metals sell off because the marginal buyer steps back. That doesn't mean gold is over. It means the hedge got less urgent. Counterpoint 3. Margin and volatility can create fake breakdowns. A spike in margin requirements or a sudden volatility shock can force selling that looks like the bull market ended. And then, when the forced selling is done, the market can resume the trend. If you don't understand that mechanism, you'll sell the low and then watch price recover without you. And that's how people get permanently cynical. Counterpoint 4. In extreme risk events, the dollar can spike. In true liquidity panics, people sell what they can to get what they need. Sometimes that means gold gets sold temporarily to raise cash. That doesn't invalidate the long-term thesis. It just means the short-term plumbing is brutal. If you don't know that, you'll misread a temporary liquidation as a permanent change. So how do you protect yourself from the psychological trap? This is the part that actually helps you in real life, not just on paper. Volatility will try to convince you that you're wrong right before it proves you right. It does this by attacking your time horizon. It does this by attacking your need to feel safe. It does this by making you stare at your screen until every tick feels like destiny. And then it pushes price just far enough against you that you capitulate. That's not because the market hates you. It's because markets are designed to discover the price where the most participants are uncomfortable. That's how the transfer happens from weak hands to strong hands. So you need rules that don't change mid-candle. You need to separate trend signals from noise. Trend signals are things like, does the market reclaim levels after dips? Do higher lows form? Does the structure remain tight? Are dips bought on volume and speed? Do spreads stay firm? Noise is a headline, a single spike, a sudden flush at 2 a.m. in thin liquidity, a social media narrative shift. Noise is designed to move you. The trend is designed to persist. And if you're going to participate at all, you must size for volatility. That's not boring risk talk. That's survival. Because even if your thesis is correct, price can whip around violently. Metals can spike, then retrace hard, then spike again. That doesn't mean manipulation. It means leverage, options, and liquidity. Now, let's translate all of this into a clean, near-term roadmap. What to watch next week and into the end of this month. Because this is where most commentary fails. They give you a story, but not a dashboard. First, watch the term structure and the way near-term pricing behaves relative to later delivery. You don't need to be a professional spread trader to respect the signal. If the need-it-now bid stays strong, that supports the idea that the move is anchored in tightness and urgency. If it relaxes sharply while price stalls, that can be an early hint that the market is shifting from physical urgency to paper momentum. Second, watch inventory narratives carefully, but don't get trapped by simplistic numbers. Not all inventory is equal. Metal that exists in eligible categories is not necessarily available for delivery at the price. Deliverable supply is a different thing. And in stress windows, what matters is not global metal in existence. It's deliverable metal in the right place at the right time. Third, watch volatility and margin dynamics as a signal, not as a verdict. If you see volatility jump and then you see risk controls tighten, expect weird candles, expect violent swings. Don't confuse that with the thesis breaking. Ask what it forces participants to do. Forced selling can create opportunity, but it can also create real pain if you're oversized. Fourth, watch options behavior around major levels. Round numbers, recent highs, areas where price accelerates. If you see price slice through key strikes and then keep going, that can be dealer flow adding fuel. If you see price approach a level and then stall with heavy two-way action, that can be the market trying to decide whether it wants to commit to the next regime. Fifth, watch the calendar like a hawk. Month end. The days leading into the Fed meeting week, the days right after. Liquidity can be thin, positioning can be nervous, and nervous positioning can produce outsized moves. If you've ever watched a market gap on a perfectly reasonable headline, you know exactly what I mean. It's not the headline, it's where everyone was positioned when the headline hit. And that's the part people miss. Price moves are often less about the news itself and more about the mismatch between expectations and positioning. If everyone is leaning the same way, even good news can produce a sell-off, and even bad news can produce a rally. Because the trade is crowded and the unwind is mechanical. Now let S bring it home with the only question that matters if you are trying to keep your head. What would actually weaken or invalidate the idea that gold and silver are the last safe bet right now? It would be a clear, credible reduction in regime uncertainty. Not someone saying everything is fine, but the market actually believing it. It would be spreads normalizing and staying normal, suggesting that immediacy is no longer being bid aggressively. It would be liquidity returning in a way that reduces the need for hard asset hedges. It would be a sustained breakdown below key support levels with follow-through, meaning sellers are confident, not forced. It would be evidence that the tightness was a temporary bottleneck that got resolved and stayed resolved, and what would confirm the thesis in the near term. You'd see pullbacks get bought, you'd see higher lows, you'd see the market respect key levels even in volatility. You'd see term structure stress persist or return quickly after dips. You'd see policy uncertainty continue to generate risk-off episodes where metals absorb capital. You'd see institutions continue to treat gold as a reserve anchor. And you'd see silver S volatility remain elevated because it S both monetary and industrial, meaning it can behave like a safe haven one day and like a rocket fuel speculative asset the next. And if one level breaks, the math changes. That's why I'm not here to tell you buy because doom. I'm here to tell you why the market is behaving like it is, what mechanisms are doing the heavy lifting, and how to stop getting played by volatility. Because the biggest trap in markets like this is thinking you need to be right about the world. You don't. You need to be right about what forces participants to act in the next week or two. That's it. That's the game. So here's your final no-drama checklist into this end-of-month window and the Fed meeting days. Watch whether dips are bought quickly or slowly. Watch whether major levels hold after they're tested. Watch whether spreads show now urgency or relax. Watch whether volatility is rising alongside price or against it. Watch whether policy headlines are expanding uncertainty or compressing it. And watch whether liquidity feels thin, because thin liquidity is where squeezes happen and where panics get manufactured. And one last thing, because this is the quiet warning nobody wants to say out loud. Volatility will be used against you, not by a villain twirling a mustache, by the market itself, by your own nervous system, by the speed of candles, by the urge to do something just to stop feeling uncertain. If you remember nothing else, remember this. You do not need to react to every move. You need to react to the structure changing. If you're the kind of person who wants the framework instead of the hype, you're already in the right room. Stick with people who talk in mechanisms, not slogans. Stick with people who can name the invalidation, not just the target. And if you want more of these, what to watch next, breakdowns, where we treat markets like systems, not like stories, then stay close, because the next 2 weeks are exactly where the market will reveal whether this is a controlled reset or a continuation event that makes everyone who mocked metals suddenly pretend they loved them all along.